markets are selling off across the board, and that's very unusual. It's associated with crises and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly.
In today's video, ARK CEO, CIO, Cathie Wood, weighs in on M2 growth, inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation. Before listening to her, please ensure to smash the like button and subscribe to the channel. Let's dive into her last interview now.
This was not a period of embedding inflation expectations, and yet Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd. And what do I mean by that? Well, Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase, not a 2-fold increase. Now, many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then, and it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different, it's such a low base. That's the whole point, it's a low base, 13 times. So if they raise the Fed funds rate another 75 basis points, this will be a 16-fold increase compared to Volcker's 2-fold increase. Now, we have been expecting serious ramifications, financial and other ramifications, because of this monetary policy. And we've gotten the first one, but most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. But I was in the UK around the time that it had its near Lehman moment. Near Lehman moment means the financial system implosion. And that was just about 10 days ago. Now, what do we mean by that? Well, there is something called LDI, liability-driven investing, and it's where pension funds match their liabilities with assets. So they will, in its pure form, they will match 1-for-1 the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safety to the system point of view. But they don't. And with banks, and a very low interest rate environment, they got used to using derivatives and taking shortcuts to try and accomplish the same goal. And after a very long period of very low interest rates, I heard someone say the other day, and we were talking about this LDI crisis in the UK, that the reason it's so serious is pension fund sponsors were beginning to think, and banks were beginning to think, that interest rates would stay very low for a very long time, for as far as the eye could see. And that assumption was built into the kind of derivative activity they were doing. No one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those margin calls were the banks, the counterparties in this case, for these derivatives. And so the Bank of England had to step in and basically say pretty much the same thing that Draghi said, the chairman of the European Central Bank in 2011. He basically said, we're going to pull out all stops no matter what. So while the BOE had been almost forced because of currency depreciation into following our Fed with higher interest rates, this was going to cause a great deal of harm to its system, and so it had to reverse its policy. So this is another reversal in policy, or it's a bit of a shift in policy. It's an outright easing, and they said they will continue until October 15th. So now all of these pension funds, in collaboration with the banks, are deleveraging, and they have till October 14th. So what do you do if you're deleveraging in an illiquid environment? All markets are experiencing duress today. I think the Fed is a big part of that. So what do? You sell the most liquid assets. What are those? Those are government bonds. And so we're seeing U.S. government bonds, which are held in pension funds abroad, being sold, even though deflationary pressures are mounting all over the place. And so we think this is a bit of a financial crisis, and we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. Certainly this week was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until we get to 2% inflation. Well, so we'll see what happens on October 14th. By that time, I think they will have been deleveraged and will be past the maximum pressure associated with this guilt trip. So I don't take that reason as seriously, because we do believe labor force participation will, on balance, continue to trend up, especially if we're in as weak an economy as we believe. So on the weak side, again, if the Fed were data driven, it would be paying attention to employment in the ISM index for September. Below 50% means it's contracting. The job openings, so JOLTS, they dropped 1 million in 1 month. Now still strong at 10 million. They dropped 1.1 million. That's a big drop in just 1 month. So job openings are declining. We're also seeing surveys out there. I think in the U.S., among major employers, 300 have announced layoffs, and that's reflected in something called the Challenger Layoff Survey. And those layoffs, which are broad-based company layoffs, are up 68% year over year. I would also imagine that they would consider leading indicators, which in every recession and recovery, in my experience, the Fed has paid a lot of mind to. It dropped 0.3% in the last month, and that makes for 5 consecutive months of decline. And the rule of thumb there is once you've got 3, you know you're in a recession. So the Fed may be saying that it's data dependent, but it's looking at the data it wants to look at. It's not looking at the totality here. It's also making an assumption that we think is mistaken. It's very much a Phillips curve Fed. Now that's a very Keynes economic theory concept. And it basically says that rising output and employment causes inflation, or they're at the very least highly correlated. And that's just not true. If you look at the data, 80s, 90s, 2000s, you'll see that inflation came down during times when the economy was very strong. Why? It's because of productivity. Productivity growth is a byproduct, and a critical byproduct, and an anti-inflationary byproduct of good, strong recoveries. We've got gold price, the gold price down 17%, copper down 30%, lumber down 73%. Think about that. Housing is collapsing. Iron ore down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17%. Silver down 29%. DRAM prices, which are chips, semiconductors, down 46%. The Baltic Freight Index down 48%. That's an indicator of supply chain issues. The Baltic Freight Dry Index, which is just for dry goods, down 65%. Oil down 29%. And many people have been dismissing these and saying, yeah, but that's, they went to sky-high prices. They're still not down on a year-over-year basis. That's not true anymore. Gold is down 3%. Copper is down 17%. This is as of today. Lumber is down 28% on a year-over-year basis. Corn is an exception. It is up 27%. Again, Ukraine being a big problem there. We have silver down 9%. DRAM prices down 33%. The Baltic Dry Freight Index down 65%. And oil and corn. Oil is up 14%. That's as of today. It's had a big pop recently. But we do think, having come down from $130 to $90, it is in a downtrend, mostly because of demand destruction. There's another kind of esoteric price out there. I remember it from my days diving deeply into economics, and it's container board prices. This gives you a sense of, how tight the box market is because of a huge amount of trade taking place. So they are down 29% from their peak and about 53% from a year ago. So just taking the evidence and putting it together like this, there is a lot of data to be driving the Fed, which is what they say is happening, but we don't think it's happening. I just rattled off lots of examples. So let's go to the markets and then wrap up pretty quickly here. Not much to say. No, markets are selling off across the board, and That's very unusual. It's associated with crises and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators, not what they're supposed to be doing. Anyway, if you take, in the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08-09. That's how bad this is. Because bonds are selling off with stocks this time. So and one of the reasons for that is a seizing up of liquidity. As I mentioned, if people are facing margin calls or in financial difficulty, they're going to sell their most liquid asset. They will have no choice, especially with margin calls. Most liquid assets tend to be government bonds, and I think that's why we're seeing the backup in government bonds here, despite all of the deflationary signals in the pipeline. Interestingly, one price indicator associated with innovation is beginning to hold up better than other prices, and that's Bitcoin. It's been interesting to see it flatline in the last month, while other indicators are reaching for new lows. Now, this is not surprising in the late stages of a bear market.